Welcome back. Today, we're unpacking the absolute magic of dividend growth investing, or GGI for short. Now, if you follow market strategies, you know the massive appeal of passive income. But the analysis we're diving into today approaches it a bit differently. We're talking about treating your portfolio's growth as a structural, long-term wealth engine. So let's uncover the true charm of the GGI strategy. Okay, let's dive into this. Imagine for a second you have a job, and your company gives you a raise every single year, without fail. Would you ever want to leave that job? Would you want to sell your stake in it? Probably not, right? You'd hold on to that golden ticket as tight as you possibly could. Well, what if your investment portfolio could act exactly like that dream employer? That brings us to Section 1, the annual raise secret. We're looking at exactly how you can turn your investments into that predictable, growing income stream. So what exactly is dividend growth investing, or DGI? Basically, it's a strategy completely focused on finding ultra-quality companies. We're talking businesses with massive competitive moats and rock-solid free cash flow. But the absolute key here is that they possess the ability to continuously raise their dividends over time. Notice I really emphasize the word continuously there, because the strategy isn't about chasing some flashy one-off payout. It's about identifying deep-rooted corporate strength and making a major paradigm shift in how you evaluate your returns. Moving on to Section 2, busting high-yield myths. It's time we talk about how to avoid the biggest rookie trap out there, assuming a higher number right now automatically means a better long-term investment. And this brilliantly illustrates the core conflict investors face. On the left, you've got high current yield, which honestly can be a highly dangerous trap. A dividend yield might look incredibly high simply because the underlying stock price has totally plummeted due to a failing business model. It's an illusion. On the right, though, is dividend growth. The entire DGI philosophy is about completely ignoring the absolute highest current yield today in favor of securing a reliable, compounding income stream that just keeps growing year after year, sustainable wealth. Section 3, the 3 golden screening standards. This is the actionable blueprint, the exact secret formula used to identify these absolute powerhouse stocks. To spot a true DGI stock, we use a strict 3-step checklist. Step 1, a continuous growth record. Step 2, a reasonable payout ratio. And Step 3, profit growth momentum. Keep those 3 in mind. Let's break down that first criterion. You absolutely want to prioritize companies that have raised their dividend every single year for at least 10 years, or ideally 25 years or more. Think about what that actually means for a second. A company with a 25-plus year track record has proven it can survive violent economic cycles, brutal recessions, global crises, all while still handing their investors an annual raise. It elevates them to the highly elite status known as Dividend Aristocrats. So, the crucial point is the payout ratio. You really want to see this hovering right in that 40% to 60% sweet spot. It's the perfect balance. It means the company is being generous and rewarding shareholders, but, and this is key, they're retaining roughly half their profits to reinvest, innovate, and safely navigate any rough economic patches without ever needing to slash that dividend. But you absolutely have to watch out for the danger zone. If you see a payout ratio soaring over 80%, that should trigger immediate alarm bells. An 80+% payout means the company's finances are stretched incredibly thin. Any sudden operational volatility, or even just a slight dip in revenue, could force them into a devastating dividend cut just to keep the lights on. And in the DGI world, a dividend cut completely breaks the magic of compounding. Okay, our third standard is corporate earnings, or EPS. This is the foundational engine, literally the only foundation for continuous dividend hikes. It's just simple business math, really. A company cannot sustainably pay out more cash than it brings in. Without stable, year-over-year profit growth, the well for those annual raises is eventually going to dry up. That profit growth momentum is the absolute vital metric making this entire DGI engine run. Which brings us to our fourth and final section, the ultimate weapon against inflation. Because let's face it, inflation is that invisible thief constantly stealing your purchasing power, right? Let's compare DGI to fixed income bonds. Bonds pay a static amount, meaning you actually lose real-world buying power when inflation inevitably spikes. But DGI? It relies on a dynamic upward adjustment. Because these high-quality DGI companies have such strong market moats, they can easily pass increased costs right on to consumers. That maintains their profit margins, which then translates directly into dynamically higher dividends for you. It naturally adjusts upward.
Now, what's really interesting about this slide is how we clearly see the mathematical magic of yield on cost over time. Let's say you buy a stock at $100, paying a $3 dividend. Your initial yield? A modest 3%. But if they consistently raise that dividend, and by year 10 they're paying $6 per share, your yield on cost has mathematically doubled to 6% based on your original investment. Over the long haul, this compounding effect is absolutely massive.
Bringing this all together, the source presents DGI as your ultimate personal financial shield. Why does this matter so much? Well, it protects your asset value from being totally eroded by inflation. Plus, it provides incredible psychological peace of mind during wild market volatility, because you know your underlying cash flow is designed to just keep growing. Ultimately, it achieves the holy grail of investing, the dual, simultaneous growth of both your underlying assets and your generated cash flow. So I want to leave you with a final provocative thought to really ponder today. Take a close look at your own portfolio right now and ask yourself honestly, are your current investments giving you an annual raise? Or are they just offering an illusion of high yield that could completely collapse tomorrow? It might just be time to start thinking like a dividend growth investor. Thank you so much for joining me for this explainer. Keep learning, keep analyzing those payout ratios, and I'll see you next time.